Picture this. Three traders walk into a bar. The stock trader orders a blue chip whiskey and waits patiently for it to appreciate in value. The crypto trader orders whatever is trading on social media and expects it to moon by closing time. The bond trader orders a reliable beer and knows exactly when they'll finish it and how much it'll cost. Sounds like a joke, but it's actually the perfect way to understand the three main types of trading. Each one operates in completely different worlds, with different rules, different risks, and different potential rewards. And if you don't understand these differences, you're basically gambling with your money. Today, I'm breaking down stocks, crypto, and bonds trading so you can finally understand which one fits your personality, your goals, and your risk tolerance. Before we dive into each type of trading, let's understand what trading actually means, because it's different from investing. Investing is like planting a tree. You put your money in, wait years or decades, and hope it grows into something substantial. Trading is more like farming. You're actively buying and selling, trying to profit from short-term price movements. All three markets, stocks, crypto, and bonds, can be traded, but they behave completely differently. Think of it like this. If the financial world were a city, stocks would be the established business district, crypto would be the wild startup neighborhood, and bonds would be the quiet residential area where your grandparents live. Each neighborhood has its own culture, its own rules, and attracts different types of people. The key is understanding which neighborhood you want to spend your time in, because the skills that make you successful in one might get you in trouble in another. Let's start with stock trading, because it's probably what most people think of when they hear trading. When you trade stocks, you're buying and selling pieces of real companies: Apple, Tesla, Microsoft, Amazon. These companies have employees, products, revenues, and quarterly earnings reports. There's actual substance behind the price movements. Stock trading comes in different flavors, and understanding these is crucial. Day trading means buying and selling stocks within the same day. You're trying to profit from small price movements that happen in minutes or hours. It's fast-paced, requires constant attention, and most day traders lose money. We're talking 80 to 90% failure rates here. Swing trading involves holding stocks for days to weeks, trying to catch larger price swings. You're looking for stocks that might move 5 to 15% over a few days based on news, earnings, or technical patterns. Position trading is holding stocks for weeks to months, riding longer-term trends. This is where many successful traders operate because you have time to research and aren't glued to your screen all day. The stock market has some unique characteristics that affect trading. Market hours. US stocks trade from 9:30 a.m. to 4 p.m. Eastern, Monday through Friday. No weekend, no holidays. This creates predictable patterns and gives you time to think between sessions. Regulation. The stock market is heavily regulated. There are rules about pattern day trading, margin requirements, and insider trading. These rules protect you, but also limit what you can do. Information flow. Companies must report earnings quarterly and disclose major news. This creates predictable volatility around earning seasons and news events. Liquidity. Major stocks have massive trading volume, meaning you can usually buy or sell quickly without affecting the price much. Here's what successful stock traders focus on. They study company fundamentals, follow earnings reports, understand sector rotations, and use technical analysis to time their entries and exits. They know that a pharmaceutical company will behave differently than a tech stock, and they adjust their strategies accordingly. The biggest advantage of stock trading? You're dealing with real businesses with real value. The biggest disadvantage? It's a mature market where you're competing against algorithms and professional traders with million-dollar systems. Now let's talk about crypto trading, which is like stock trading's wild younger sibling who dropped out of college to start a band. Crypto trading is fundamentally different because you're not trading pieces of companies, you're trading digital assets that they exist purely as code. Bitcoin, Ethereum, Solana. These aren't companies with earnings reports. They're protocols, networks, and sometimes just pure speculation. Here's what makes crypto trading unique. 24/7 markets. Crypto never sleeps. Markets are open 24 hours a day, 7 days a week, 365 days a year. This creates opportunities, but also means you can wake up to massive losses because something happened while you were sleeping. Extreme volatility. A 5% move in stocks is significant. In crypto, 20 to 30% daily moves are normal. I've seen cryptocurrencies double or lose half of their value in a single day. This volatility creates massive profit opportunities, but also massive risks. Emotional trading. The crypto market is driven heavily by emotions: fear, greed, FOMO, panic. Social media sentiment can move prices more than fundamental analysis. When Elon Musk tweets about Dogecoin, the price moves. That doesn't happen with Apple stock. Lower barriers to entry. You can start crypto trading with $10. No pattern day trading rules, no minimum account balances. But this accessibility is a double-edged sword. It's easy to get in over your head. Leverage availability. Many crypto exchanges offer 10x, 50x, even 100x leverage. This means you can control $10,000 worth of crypto with just $100. Sounds great until you realize you can lose everything with a 1% move against you. Crypto traders use different strategies than stock traders. Scalping, making dozens of small trades per day, profiting from tiny price movements. This works in crypto because of the constant volatility. Swing trading, similar to stocks but with much larger potential moves. A crypto swing trade might target 50 to 100% gains instead of 10 to 15%. Trend following. Crypto tends to have explosive trends. When Bitcoin starts running, it can go for weeks or months. Successful crypto traders learn to ride these trends. News trading. Crypto is heavily influenced by news, regulatory announcements, exchange listings, celebrity endorsements. Traders who can react quickly to news often profit. The biggest advantage of crypto trading? Massive profit potential and 24/7 opportunities. The biggest disadvantage? Extreme risk and a market that's often manipulated by whales, large holders who can move prices at will. Now let's talk about bond trading, which is like the responsible adult in the room while stocks and crypto are having a food fight. When you trade bonds, you're trading debt, IOUs from governments and corporations. The US government issues treasury bonds, companies issue corporate bonds, and municipalities issue municipal bonds. You're essentially lending money and getting paid interest for the privilege. Bond trading is completely different from stocks and crypto. Inverse relationship with interest rates. This is crucial to understand. When interest rates go up, bond prices go down. When rates go down, bond prices go up. It's like a seesaw, and this relationship drives most bond trading strategies. Lower volatility. Bonds don't typically move 20% in a day like crypto or even 5% like stocks. Daily moves of 0.5 to 2% are more common. This makes bond trading less exciting, but also less risky. Predictable income. Unlike stocks that may or may not pay dividends, bonds pay regular interest. You know exactly how much you'll receive and when. Credit risk. The main risk in bond trading isn't volatility, it's the risk that the borrower won't pay you back. Government bonds are considered very safe. Corporate bonds are riskier, and junk bonds are much riskier. Bond traders focus on different factors. Interest rate predictions. Since bond prices move opposite to rates, successful bond traders try to predict Federal Reserve policy and economic conditions. Yield curve analysis. The relationship between short-term and long-term interest rates tells a story about economic expectations. Credit analysis. For corporate bonds, traders analyze the financial health of companies to assess default risk. Duration risk. Longer-term bonds are more sensitive to interest rate changes than shorter-term bonds. Bond trading strategies include duration trading, betting on interest rate direction by buying long-term bonds when you expect rates to fall, or short-term bonds when you expect rates to rise. Credit spread trading, profiting from the difference between safe government bonds and riskier corporate bonds. Yield curve trading, taking advantage of changes in the relationship between short and long-term rates. The biggest advantage of bond trading? Lower risk and predictable income. The biggest disadvantage? Lower profit potential and the need to understand complex interest rate dynamics. So how do these three compare in practice? Risk level. Crypto trading is highest risk, highest reward. Stock trading is medium risk, medium reward. Bond trading is lowest risk, lowest reward. But remember, risk and reward are always connected. Time commitment. Crypto trading can be 24/7 if you let it. Stock trading fits normal business hours. Bond trading is often the most relaxed, with longer-term positions. Capital requirements. Crypto has the lowest barriers to entry. Stocks require more capital for effective day trading due to pattern day trading rules. Bonds often require the most capital since individual bonds can cost thousands of dollars. Skill requirements. All three require different skills. Stock traders need to understand business fundamentals and technical analysis. Crypto traders need to understand technology, social sentiment, and market psychology. Bond traders need to understand economics, interest rates, and credit analysis. Market maturity. Stock markets are the most mature and efficient. Bond markets are also mature but less liquid. Crypto markets are young, inefficient, and full of opportunities and traps. Here's the truth that most people don't want to hear. There's no best type of trading. It depends entirely on your personality, risk tolerance, available time, and capital. If you're young, have high risk tolerance, and can handle extreme volatility, crypto trading might appeal to you. If you want to trade real businesses with fundamental value, stocks are your game. If you prefer steady, predictable returns and want to sleep well at night, bonds are calling your name. But here's my advice. Don't pick just one. The most successful traders often use all three markets for different purposes. They might day trade crypto for quick profits, swing trade stocks for medium-term gains, and hold bonds for stability and income. The key is understanding that each market has its own personality, its own rules, and its own risks. Master one before moving to the next, and never risk more than you can afford to lose. If this helped clarify the differences between these trading markets, smash that like button and subscribe for more no-nonsense financial education. Drop a comment and let me know which type of trading interests you most and why. Thanks for watching, and remember, this isn't financial advice, it's education to help you make informed decisions about your financial future.